Our next guest has made his name in value investing. He'll be speaking at the annual Value Investing Congress a little later today. But before that, he joins us first in a rare interview. Joining us right now is Joel Greenblatt. He is the managing partner of hedge fund Gotham Capital. He's also an adjunct professor at Columbia Business School and the author of a New York Times bestseller, The Little Book That Beats the Market. By the way, this book has had a very strong performance. If you were following what was laid out, the value investing formula laid out in this book, you'd be doing much better than if you'd been investing just in the S&P index funds over the last several years. Joel, we want to thank you for joining us.
Thank you.
Let's talk a little bit about the model portfolio and the secret from this book, how it's fared over the last 10 years. If you had put money into this model portfolio, would be up 291% over the last 10 years versus down 2% for the S&P 500 index. Similar results for 5 years, 3 years, 1 years. What is the secret that's laid out in this book?
Oh, the secret is pretty simple. It's really basic value investing with a little Buffett twist. So we're really looking for cheap companies, and by cheap we just mean companies that trade cheaply relative to their earnings. And we're actually looking at last year's earnings, so there's no projections involved. The other thing we want to do is buy good companies, so we're looking for companies that earn a high return on capital, and that's also measured by last year's earnings. And if you combine those two, good and cheap, you end up buying a portfolio of companies that on average do very well over time, or at least have when we've looked at all these back tests over the last 10 years.
You know, it sounds like such a simple strategy, but what trips people up when they start investing?
Well, the great thing about the formula, if you had a formula that worked every month and every day, then it would soon stop working because everyone would use it, and you would push the stocks back up to regular value, and it would be ruined by people on Wall Street. The great thing about this formula is it's not that great, meaning there are periods of time, could be 2 or 3 years sometimes, sometimes longer, where it underperforms the market. And people usually give up on a formula that underperforms the market for that period of time. But over the last 10 years, it's almost quadrupled. If you invested in this formula, which is holding your securities for over a year each time, it's still quadrupled the market's return. Over the last 5 years since I wrote the book, the returns for the formula have been up 73% versus the market up 5%. Over the last year, up around 14% versus the market down 7%, ending September 30. So it's still doing pretty well.
But what happens is people let their emotions kick in and say, okay, I've been down for 6 months, I've been down for a year, I've been down for 2 years, and they step away from the formula?
Well, the formula's done incredibly well over the last 10 years, but still, during those 10 years, there were 2 periods. There was practically a 3-year period where it underperformed the market, and then another period of over a year. So that's over 4 years and change. Usually, people give a money manager 1 year or 2 years, and then they say, forget about it. So a lot of people would have quit on the formula, even during a period where it did very well. And since I wrote the book 5 years ago, a lot of people have asked me, gee, I thank you for the formula, but can you just do this for me? And so we actually set up a firm just recently. We're actually launching it today, formulainvesting.com, and we'll actually follow the formula.
You will.
Would you call it, is it buy and hold? Is it that simple?
Right. Well, the way we do is we buy a portfolio of securities, usually between 20 and 30 securities. They're each held for a year, so that if you have a gain, you get a long-term gain. If you have a loss, we'll sell it a little before a year. And that's sort of the strategy that it follows. So it's not a fast trading strategy. And it may not work, like I said, for a period of years. Even during a period where the formula works incredibly well, for a period of years it may not work. And I think that's why it'll continue to work over time. And that's the basis of value investing.
2 questions. How did it do last year during 08? And 2, what's the best stock out there right now?
The answer to your first question is that it lost a little bit less than the market, and I think the market was down about 37% last year, and the formula was down about 36%, so not much better than the market. But over the last 12 months, it's been up about 14% versus down 7% for the market, ending September 30. And so there are periods when either it doesn't do as well as the market or actually loses money. In other words, you're 100% long the market, and you're subject to how the market goes. But if you have a long-term investor, and you need if you're going to invest in the market, you really should be a long-term investor. If you're going to be a value investor, you really have to be a long-term investor because you're going to be buying unpopular stocks that sometimes don't work out for a period of time. But if you have a long-term horizon, you've practically quadrupled your money over the last 10 years when the market was down 2%. So that's not going to happen every 10-year period, but it just shows you what can happen, by following a very strategic, unemotional, systematic investment strategy.
Joel, can you run this in a hedge fund format? Because you're right. I mean, value strategies work and then they don't work. But what do you do in the drawdown period if you're a hedge fund manager? How do you protect against that?
Well, the great thing is this isn't a great strategy for a hedge fund manager. It's very hard to hedge out these kind of companies. You're buying out-of-favor companies. You don't know when they're going to work out. You buy a portfolio of them. So on average, they do well over time. You're not even sure which ones are going to do well when you're buying them. And that's why if you're following a statistical formula like this, you really have to buy a basket of securities. Sure. And it's not really good. There's a lot of reasons, and we can go into them, not really appropriate for hedge fund managers. And that's why I think it'll continue to work, even though I'm giving away the secret.
Just back to Dennis's question. Is there one stock that stands out as having been the best pick?
I don't really want to pick one stock. I mean, there are a lot of stocks, and you would probably look through the list of 20 or 30 stocks that the formula is telling you to pick now, and you'd know a reason why you shouldn't buy any one of them. In other words, I know what's wrong with that. I know why it's cheap. I know why this isn't good. I know why that's not good. But if you buy them as a basket, in general, they will work out. They're out-of-favor companies at the moment, but they're still selling cheap relative to their earnings, and they're good companies. They earn high returns on capital, and that's sort of what we're trying to combine here.
All right. Well, Joel, we want to thank you very much for joining us today. Appreciate your time.
Thank you.